A monthly checking account fee now averages $13.95, a record high, and yet millions of Americans pay nothing at all for checking every month forever. So here's the actual question. If a bank can charge nearly $14 a month and often doesn't, what is it earning off you instead? In our last video, we found that checking accounts are the cheapest possible source of money a bank can get. Many pay just 0.07% interest, essentially nothing. That single fact turns out to be the beginning of the entire story. Today we follow the money into the account almost everyone has and almost nobody questions, using data from the Federal Reserve, the CFPB, and public interchange filings, sourced on screen the whole way through. One note before we start: overdraft fees are their own enormous topic, big enough to get their own video next time. Today is everything else. The parts of checking account profitability that have nothing to do with a mistake or a shortfall on your end. Let's get into it. Pillar 1. Every time you tap your debit card, a fee moves, and it's bigger and more unequal than most people realize. This is called a debit interchange fee, and unlike the credit card interchange we covered 2 videos ago, this one is actually regulated by law. A rule called the Durbin Amendment caps what large banks, anything over $10 billion in assets, can charge merchants per debit swipe, 21 cents, plus a small percentage of the purchase, landing around 23 cents on average. Worth knowing what this looked like before the rule existed. Prior to 2011, the average debit interchange fee ran about 44 cents per transaction, nearly double today's capped rate. So the regulation genuinely cut the fee substantially. And yet here's the part that rarely gets mentioned. The actual cost to process that same transaction today is somewhere between 4 and 8 cents. So even under a cap that already cut fees nearly in half, a covered bank is still charging roughly 3 to 6 times its own processing cost on every single swipe. And it gets stranger. That cap only applies to banks over $10 billion in assets. Smaller banks, credit unions, and fintech apps are completely exempt. And according to the most recent Federal Reserve data, exempt issuers charge an average of 51 cents per transaction, more than double what the big regulated banks are allowed to collect, and actually higher than the pre-regulation average across the entire industry. The same swipe, the same card network, over twice the fee, depending entirely on which institution issued your card. Here's what that looks like at scale. The average American makes about 23 debit card purchases a month. At 23 cents a swipe, that's roughly $5.30 a month per customer, just from interchange, for a big, regulated bank. At an exempt institution charging 51 cents, the same 23 swipes generate closer to $11.70 a month per customer. Now multiply either number across a bank's entire customer base, often millions of accounts for a major issuer. And a fee measured in cents turns into one of the largest, steadiest revenue lines checking accounts produce, industry-wide, collected from merchants, never appearing on your statement at all. Pillar 2, and this is the one our last video already set up without either of us realizing it yet. A checking account is, for a bank, the cheapest money it will ever get. We already know checking accounts pay close to nothing, 0.07% on average, a number we covered in detail last time. But a bank doesn't just let that money sit there. It lends it out or invests it, the exact same way it does with savings deposits, except this money costs the bank almost nothing to hold on to. Remember net interest margin, the spread between what a bank pays depositors and earns on loans. Checking deposits sit at the most profitable possible end of that spread because the cost side of the equation is essentially zero. Banks have an internal term for money that behaves like this: non-interest-bearing deposits, or more informally, the float. Picture a fairly typical checking balance of $3,000 sitting at a bank paying 0.07% on it, costing the bank about $2 a year to hold. If that same $3,000 gets lent out or invested at even a conservative 5% return, the bank earns roughly $150 a year on money that cost it $2 to keep. That gap, nearly the entire $150, is close to pure margin, and it exists whether or not you ever pay a single fee, ever get charged interest, or ever interact with the bank beyond leaving your paycheck there. The bigger and more stable your checking balance, the more valuable you are to the bank in this specific, quiet way. Pillar 3. The monthly fee itself, and why so many people never actually pay it. That record $13.95 a month isn't charged uniformly. It's usually waived, and the waiver conditions are the actual design. Common requirements include maintaining a minimum daily balance, often somewhere between $1,500 and $5,000, or receiving a qualifying direct deposit, or completing a set number of debit card purchases each statement cycle. Miss any one of these in a given month, and the fee simply appears. Banks know, from years of account data, roughly what share of customers will consistently clear these bars and what share won't. The waiver structure isn't a guess, it's priced, the same way we saw deposit beta priced in our last video. And this record high didn't happen by accident either. Regulators have spent the past few years scrutinizing what they call junk fees across consumer banking: overdraft charges, wire fees, paper statement fees, and monthly maintenance charges among them. Even amid that scrutiny, the average monthly fee kept climbing to its current record, which tells you something about how central these charges remain to the underlying business model, regulatory attention or not. It's also worth noticing who doesn't play this game at all. Several newer, online-only checking accounts and fintech apps skip monthly fees and balance minimums entirely, relying almost completely on interchange revenue instead. Proof that a checking account can be genuinely profitable without a maintenance fee ever entering the picture, and a useful signal for what a checking account actually needs to charge you versus what it's simply been able to. And there's a second, quieter revenue stream layered on top of all of this: fee or no fee data. Every checking account generates a detailed record of exactly where you shop, how often, and how much you spend. Banks use this information to build profiles that inform which credit cards, loans, or investment products get marketed back to you, turning your own spending history into their next sale, a pattern we've now seen in a slightly different form in 2 of our last 3 videos. So, 3 pillars: debit interchange, a regulated fee that still runs several times the actual cost to process it, and runs even higher at any bank below the regulatory threshold. The float, the fact that checking deposits are the cheapest money a bank will ever hold, quietly maximizing the exact spread we covered last video, turning a $2 cost into a $150 return on an entirely ordinary balance. And the fee waiver structure, monthly charges engineered around thresholds that banks already know statistically how many customers will miss. None of this requires you to do anything wrong. The account can be genuinely free every single month and still be one of the most profitable products a bank offers. Just not because of a bill you can see. If this made one more part of your everyday banking a little less invisible, that's what this channel is for. Money, explained with the receipts on screen, not vibes. Next video, we're finally covering the fee everyone already suspects is bad, and it's worse than you think: overdraft charges and exactly how a single $3 coffee can turn into a $35 penalty. Subscribe so you don't miss it. See you there.